Hey YouTube, Jason here with Day Trading Fearless. Welcome back to my channel. If you're new, welcome. Make sure you guys hit the like button and also subscribe. And all these option videos are sponsored by myself. So these are the weekly trade zones for the S&P Emini futures. $50 one-time payment for a lifetime subscription. I've been doing these for about 7 or 8 years now. And every weekend I send you all these trade levels. Again, $50 only. Go to daytradingfearless.com or click the link down below in the description. And also make sure you check out my Patreon page at patreon.com/daytradingfearless to follow along with my trading portfolio. So, with that being said, let's jump into the option video course, and I hope you guys enjoy it. And thank you for watching. Hey, in today's video, we're going to talk about a protective put. In the previous video, we talked about protective calls. Well, now we're just going to look at doing a protective put, which is essentially the opposite trade than we did with the calls. So our opinion is neutral to bullish, right? We're bullish on the trade. A protective put is a position where you are long the stock and you buy a put option. This is a position that you think the stock will head higher. So you're long stock, but are protected if you are wrong and will be hedged by the long put to the downside, just like it's insurance, right? So what you would do is you would buy 100 shares of stock, okay, or of XYZ stock at $20. You would buy one XYZ October 20 put for $1. Okay, so you buy that put for $1 debit. Your max loss would be the $1. Your max profit is unlimited because the stock could go as high as it wants, because think about it, right? If you buy the $20 call and it goes to 40, you're gonna make $2,000 on the shares you own. But remember, you paid $1 or $100 in premium, so you would lose that. So net you would make $1,900 on that trade. Your break even is if the stock closes at $21 at expiration. So here's the example. Stock XYZ is at $20 and you will get long 100 shares. You will also buy one October 20 strike put for $1. Your break even is $21 because you paid $1 for the put. The put you bought acts as insurance because if the stock goes down to $15, then you have lost $5 on the long stock, but the October 20 put you buy has made $4 because you have paid $1 to have the right to be short the stock at $20. This type of trade also gives you a limited risk of $1 and a unlimited profit potential to the upside. So protective puts are a really good strategy if you're you want to hedge in case there's a pullback, anything like that, but you are bullish the market. And you usually want to do trades like this in low volatility markets, because with the low volatility, you're going to have cheaper options for those puts. If you do in high implied volatility, you're actually going to be paying a lot more in premium. So protective puts really, really good if you're bullish, like for more longer term trades, but you just want that protection to the downside. So that's it for this video. We'll talk to you on the next video.